please welcome Spencer Applebaum, investment partner at Multicoin Capital.
Good afternoon, everyone, and thank you for being here at the Multicoin Summit. My name is Spencer Applebaum, and I'm a partner on the investment team at Multicoin. The last 2 years, my talks have focused on DeFi, specifically centered around value capture and capital efficiency. Today, though, I want to zoom out and talk about something that's even more foundational, stablecoins. Stablecoins aren't just faster or cheaper payment rails. They're the first new financial building block in decades, and they're quietly rewiring the infrastructure of fintech itself. So in this talk, I want to dive through fintech's history, why we believe it got stuck at the surface, and how stablecoins finally let us rebuild finance from the ground up, enabling specialized platforms that could really never exist before. So let's jump in. So to frame all of this, I want to break the history of fintech into 4 distinct phases. Phase 1 that started around 2000 was digital distribution, and that was bringing finance online. Phase 2 was neobanks, which were companies that used brand and segmentation to reach specific user bases. Following that, Phase 3 was embedded finance, where apps like Uber and Shopify added financial features directly inside their platforms. And Phase 4, what's emerging now, is stablecoins and permissionless finance. Each of these phases expanded access to financial services. But the 4th phase is different because it finally swaps out the underlying machinery. Instead of renting the banking system, builders can operate on open and programmable rails. Instant, global, composable money unlocks ideas that the earlier phases simply could not touch. So let's start with phase 1, which, as I said, is digital distribution. The financial pipes, think things like ACH, SWIFT, Visa, and core banking, were already there. Early fintechs didn't rebuild them, they just made them easier to access. So PayPal simplified online payments, E-Trade brought trading into your browser, Payoneer helped freelancers move money globally, and Prosper created a lending marketplace for peer-to-peer loans. The breakthrough of this era was access, but not infrastructure. Fintechs here made financial tools easier to reach and to use, but the way that the money moved stayed exactly the same. Phase 2, that started around 2010, was the rise of neobanks. Smartphones and social media let fintechs target very specific audiences with tailored features and branding. Chime offered no-fee accounts and early paycheck access for hourly workers. SoFi focused on graduates with strong earning potential like med students and law students. Robinhood gave young investors commission-free trading. These companies nailed segmentation and user experience, but underneath the apps, every product still depended on the same sponsor banks and card networks. Great design gave them reach, but it did not improve their unit economics because the underlying rails remained unchanged. So then came phase 3, embedded finance. And this completely flipped the model for customer acquisition. Instead of competing for attention, apps with large user bases, so think companies like Uber, Shopify, and DoorDash, started offering financial products directly inside their platforms. APIs from Synapse and Marqeta made it easy for them to bolt on cards, accounts, payouts, and more. So take Uber. Before embedded finance, a driver might have to wait days to get paid. But with instant payouts, they can finish a shift, tap a button, and money hits a virtual card for them within minutes. To the end user, it feels absolutely magical. But under the hood, nothing fundamentally changed. The APIs still routed through the same networks, the same settlement delays existed, the same fees, the same fraud rules, et cetera. So embedded finance improved distribution, but the economics still flowed back to the same intermediaries and not these platforms building on top of them. Here's the problem, really. Fintech never created new financial primitives. Deposits, payments, lending, these are centuries-old concepts. Fintech mostly just enhanced the interfaces. And by 2022, nearly every fintech sat on the exact same stack. The same sponsor banks, the same banking-as-a-service providers, the same compliance vendors. For example, Rocket, Coinbase, Stripe, and Affirm all were reliant on Cross-River. And when everyone builds on identical rails, what you get is thin margins and lookalike products. At the same time, regulators started tightening the screws. Consent orders came from the OCC, FDIC, and the Fed, and they hit sponsor banks like Cross River and Evolve. That resulted in deeper audits, stricter controls, and eventually higher costs that slowed growth. So fintech drifted from engineering toward branding. Card colors, sign-up bonuses, and cashback gimmicks are how fintechs tried to differentiate. The innovation shifted from infrastructure to customer acquisition, and that's where we believe the industry got stuck. By 2022, it kind of became clear that the old fintech playbook had run out of steam. CAC kept rising, regulators got tougher, and higher interest rates exposed just how much the sector depended on cheap capital to subsidize growth. Investors flipped almost overnight from, grow at all costs to show me the unit economics. And the data actually reflects that. According to SVB's 2025 FinTech report, the median US FinTech is now cutting burn by about 15% a year, which is pretty wild to think about because in 2021 and 2022, they were growing burn by 80 to 90% year over year. Additionally, median Series A revenue jumped from $1 million to $4 million because investors, again, suddenly wanted real business models instead of just top-line user growth for the sake of growth. Admittedly, some of this was macro, but a lot of it was structural. When your margins depend on interchange and sponsor banks, you don't control your economics. Your fate is tied to rails that have not changed in decades. So the natural question is then, why did innovation stay stuck at the top of the stack? And we think there are 3 reasons. The first one, as you can see on this slide, is regulation. Only chartered banks or licensed entities can move money. And after 2008, the FDIC basically stopped approving new charters. So as a fintech, you couldn't innovate at the core without a charter, and you couldn't get a charter. So all of these fintechs were pushed to innovate at the edges on things like UX, onboarding, and distribution, rather than on the underlying rails. Second, fintechs were locked into the dominant payment rails of the time. Visa, MasterCard, and ACH didn't just move money. They dictated the economics, the fraud rules, and the settlement times. So as a fintech, you had to accept fixed fees, chargeback and fraud policies defined by all of these networks, slow batch settlement, and interchange economics that capped your margins. You didn't control the rails, and so you didn't control the business model. You could improve on UX, but again, the economics always flowed back to the networks. And third, and perhaps most importantly, launching a fintech could be incredibly expensive. Before you could even shift a product, you needed millions in upfront spend on things like compliance programs, fraud tools, KYC and KYB vendors, dispute management systems, data aggregators, core ledgers, and all of the integrations to tie them together. Then on top of that, you had customer acquisition, which was often another multi-million-dollar line item. And Lex Sokolin actually captured this pretty well. He wrote that acquiring a neobank customer in the neobank era typically costs anywhere from $200 to $500, depending on which product you're trying to sell. And again, all of this was happening before you earned a single dollar of revenue, or if you knew whether the user would stick or not. What's important to note is that these weren't necessarily failures of creativity by the last generation of fintech founders and companies. Rather, they were structural constraints. Chime could only move as fast as Bancorp. Cash App still had to route every swipe through Visa. And Brex relied on Immigrant Bank to issue credit. So fintechs innovated at the edge and not the core. They built amazing products, but all on top of the same old plumbing. Without new rails, you can't re-architect finance. You can only reskin it and capture a tiny slice of the margin. As this chart shows, fintechs keep anywhere from 28 to 33% of the value they create. The rest flows back to sponsor banks, payment networks, and all of the legacy infrastructure you see here. So now we arrive at the 4th phase of fintech, which is stablecoins. Again, stablecoins aren't just faster rails. They're a new foundation for financial software. Programmable, internet-native dollars that move instantly, globally, and 24/7. Importantly, they're actually one of the fastest growing sectors in all of technology. Stablecoins grew from about $20 billion 5 years ago to $300 billion of market cap today. And today, they actually process more real economic volume than Visa, PayPal, and a lot of the major remittance networks, even after you strip out things like MEV, arbitrage, and centralized exchange to centralized exchange wash flows. The conclusion here is that for the first time ever, non-bank, non-card rails have reached true global scale. So we think that stablecoins are growing so fast because they offer 5 structural advantages over legacy rails. First, they offer instant settlement. There's no delays, no cutoff times, and extremely minimal chargeback risk. Second, they're transparent. They live on real-time auditable blockchains, so anyone can verify a payment without waiting or wondering when it's going to land. Third, they're programmable. They enable streamed payments, automated yield flows, and things like multi-signature wallet management. 4, they're composable, so any developer can plug in lending, payments, compliance, or trading functionality without asking permission. And 5, they're globally interoperable. It's a 24/7, 365 network with no borders, no banking hours, and absolutely no downtime. So what actually changes when you build on stablecoins and permissionless APIs? In the old world, launching a fintech meant stitching together a long list of vendors. That included things like a sponsor bank like Cross River or Evolve, a card issuer like Marqeta, fraud tools from Sift or Unit 21, compliance from Ally or Socure, reconciliation and ledger systems from Move or Modern Treasury, chargeback vendors like ChargeHound, data aggregators like Plaid, and clearing providers like Apex. Each piece here added cost, delays, audits, and ongoing maintenance. Stablecoin rails collapsed that entire chain into permissionless APIs. What used to require legal contracts now become smart contracts on a public blockchain. For example, custody runs natively on-chain through something like our portfolio company Squads' Altitude product. Payments settle as direct stablecoin transfers with no Visa, no MasterCard, and no ACH in the loop. Identity becomes portable through tools like ZK.me. Disputes disappear because on-chain transfers don't reverse. Data aggregation becomes unnecessary because balances and cash flow history live directly on-chain, and so credit underwriting can pull real-time signals from wallets instead of PDFs or emailed bank statements. And lastly, compliance moves to the wallet level, blocking sanctioned addresses before a transaction can even occur. So once you replace all of these vendors with modular permissionless APIs, the economics completely flip. What used to take years and millions of dollars can now be built in weeks for tens of thousands simply because these intermediaries disappear. So I want to circle back to segmentation for a sec, which I earlier said is the strategy that kind of defined the neobank era. SoFi focused on high-earning graduates, Greenlight targeted families with teens, Chime helped hourly workers get paid early, and Brex went after startup founders. In a lot of cases, these wedges worked really well, but the challenge was that rising overhead started crushing their margins. Interchange was capped out by the networks, and compliance, fraud, and sponsor bank fees kept climbing. CAC exploded from $40 a user to well over $200 as performance marketing got saturated. And so to make the math work, fintechs were pushed to start expanding horizontally. A savings app added lending. A teen card app added investing. Business card apps added cash management. And in a lot of cases, it wasn't because users demanded it. It was because legacy rails made specialization too expensive. On old infrastructure, specialists eventually had to become generalists. And now we've seen stablecoins completely rewrite the unit economics of fintech. Uber showed us in the embedded finance era just how powerful zero CAC distribution can be. Drivers were already on the platform, and so instant payouts took off immediately. Stablecoins let vertical fintechs run the exact same playbook, but with a totally different cost structure. Sponsor banks, card networks, fraud tools, reconciliation teams, and dispute ops shrink into simple on-chain functions. And niche markets come with their own built-in distribution. Groups like esports creators, sneaker resellers, luxury goods dealers, K-pop fan groups, it doesn't really matter. All of these companies already share information. They have a lot of trust embedded into the community, and you can get them to onboard their friends through word of mouth. So CAC collapses because users recruit each other, and margins expand because all of the middlemen disappear. That combination, cheaper users and more profit per user, turns a 10,000-person community into a viable business model as a fintech. And on old rails, that was too small. But on stablecoin rails, it's more than enough. And that's the fundamental shift. Vertical fintech finally becomes economically viable again. So we highlight a bunch of groups here that we think could be interesting communities for specialized stablecoin fintechs, and I want to double-click into a few. So first, I highlight professional athletes in solo sports like tennis and golf. Their income swings wildly, it spans across multiple jurisdictions, and it comes with real injury risk. A stablecoin fintech for them could bundle everything they need. It could tokenize their future earnings so they can hedge them. It could automate tax withholding on a per-country basis. It could have built-in injury insurance, project their income based on an ATP or PGA schedule, optimize their travel rewards because of how often they're away from home, essentially the whole bundle. It's basically a digital private banker designed for the realities of professional sports. Another example here is the fan industry and adult creators and performers. They generate billions of dollars in revenue globally, but they're routinely deplatformed and pay 10 to 20% fees to high-risk processors like Epoch and CCBill. Payments are frequently delayed, censored, or even reversed with very little recourse. A stablecoin neobank can flip that dynamic. Instant settlement, 1 to 2% fees, verifiable on-chain income so that they can get credit, and wallet-level privacy controls for safety. The last example I'll highlight here is luxury goods and watch dealers. They move millions of dollars in inventory every day, a lot of times across borders, but they rely on slow wires and high-risk payment processors. A lot of them can't get short-term financing either because their capital sits in display cases or vaults and not in bank accounts. A stablecoin fintech could solve both of their problems. It would offer them instant settlement for large payments via on-chain escrow, and it would offer them credit lines secured by inventory that gets tokenized on-chain. This is a small sector by headcount, but it's extremely big by value, exactly the kind of niche market that stablecoins can fix. So the examples that I've gone through on the last few slides are just a select few, but I think the pattern becomes clear. The communities that traditional banks avoid, whether because they're too small, too global, or too risky, become viable high-margin markets on stablecoin rails. And it's only possible because stablecoins collapse the cost of launching and operating these businesses. So to wrap up, the story of fintech has always been about access. Phase 1 brought finance online. Phase 2 personalized it with neobanks. Phase 3 embedded it into everyday applications. And Phase 4, stablecoins and permissionless finance, finally rebuilds it from the ground up. For 20 years, fintech innovated on customer acquisition and made the front end better, but the underlying rails never changed, and now they have. Stablecoins make money programmable, global, and composable, and in doing so, they completely collapse the cost of building financial products. The amazing thing is that when costs fall by orders of magnitude, what's possible expands by orders of magnitude. We move from a handful of giant banks to thousands of specialized financial platforms, each tuned to a specific community, market, or need. And at Multicoin, we're investing across that shift. So on the venture side, we're looking to back the specialized stablecoin fintechs and the middleware that enables them, including teams in our portfolio like Squads, LeFi, Fund.xyz, and Yield.xyz. On the hedge fund side, we benefit as these platforms bring more users on-chain, where they naturally get digital dollars and start lending, borrowing, and trading across protocols like Camino, Drift, dFlow, and Athena, all on public blockchains like Solana. Thank you for your time today, and if you want to go deeper on the thesis, come find me or our analyst Eli afterward. I think Eli's over there, yeah. He was truly instrumental in helping me shape this talk. So now I'll hand it off to Nitesh to talk about the evolution of market microstructure. Thank you.